welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
I want to see a retest specifically for Nvidia of a break below $100 a share, because the last time that happened, the stock found some support and very quickly bounced back to 130, so it was threading a all-time high. So I'd like to see a successful retest of those lows that were set just a month ago.
We're looking at this as just another sign of normalization, but you sort of have to look at this critically as well, that you don't want normalization to turn into deterioration where you're getting into this self-propelled feedback loop where the labor market starts to just get worse and worse.
We've got plenty of other labor market data for the market to pay attention to this week with that jobs report on Friday. And I think the market has quickly shifted from hyper-focus on inflation to hyper-focus on the labor market. So that's really what's to watch for this week.
We got an hour to go until the market closed. So let's take a look at the move over the market today, because even though right now you're not seeing that much movement, we've had a pretty decent range today. The Dow earlier rising, now down about 79 points, about 0.2%, and that is mirrored in the other major averages. The S&P now down about 0.4, as is the Nasdaq. Couple of big things to consider today for investors on the economic front. We got the JOLTS data this morning, the job openings and labor turnover survey, and that's showing the lowest number of job openings since 2021. Then we also got the beige book, and the beige book, not great in terms of sentiment.
Yeah, I just wonder, Julie, if you look at the economic data we've gotten this week, so manufacturing, JOLTS, you mentioned the Fed's beige books, the number of districts reporting flat or declining activity jumped, right, 5 to 9. I do wonder whether maybe that's just weighing on growth concerns starting to bubble up again. Obviously, we had them about a month ago. There was raw panic in the market. Then everybody kind of took a deep breath and regrouped. The market moves higher, but I just wonder if they're starting to bubble up again, and of course, all with the big jobs report on tap.
Yeah, it definitely feels that way, right? Yesterday, we talked to Citi Chief U.S. Economist Andrew Hollenhurst. He said he expects a much lower addition of jobs when we get the Friday jobs numbers for August, and he thinks the Fed is going to have to do a 0.5 percentage point cut when it, of course, makes its decision in a couple of weeks here. If you look at what's going on in yields, this is really the tail that's wagging the equity dog today. It seems like, right? You've got this drop in yields happening after that economic data today, a drop of about 7 basis points, 3.78%. Just to put that in a little bit more perspective here, you see it coming to that lower end of the range where it had been. So that's part of the story today, the economic data. And then we got to talk about what's going on with the tech trade today as well, which earlier in the day looked like a bounce back from yesterday's selling.
Yeah, I mean, it's interesting. I'm really glued on Nvidia, which is interesting because we did see a reversal there. It had calmed down and obviously dropped about 10% yesterday off those Bloomberg headlines. I think investors, in part what's going on here, obviously, I think they're still trying to think through those headlines. I thought it was really interesting. We had tech analyst Patrick Moorhead on Yahoo Finance today kind of helping us think through what it could mean. And I thought his comments were really fascinating. In part, he was saying, listen, antitrust allegations and actions tend to be infectious, in his words. They tend to spread. He was thinking, you will see this spread to other jurisdictions, including, and he called out, Europe, Taiwan, and Korea.
Well, yeah, and spreading maybe among some of the other semiconductor companies as well, because after all, that report said the Department of Justice is not just looking into Nvidia, it's at Nvidia and other companies. One more thing I just want to point out, as we look at a lot of red among the large caps here, Meta's not down. But also, look at Tesla.
Nice pop.
Up about 4% today. There's not any particular catalyst or headline, but it's held up better than the rest of that large cap tech after falling yesterday. And then there is another big stock that we got to watch, a developing story that we are monitoring here, and that has to do with U.S. Steel. Now, according to a report today in the Washington Post, President Biden is preparing to block Nippon Steel's takeover of U.S. Steel, and you can see a big decline in the shares when those headlines coming out here. Remember, Nippon had agreed to buy U.S. Steel for $14.9 billion, and we have various regulatory bodies examining that. The Committee on Foreign Investment in the United States, CFIUS, has been examining it, has not yet presented its findings to the administration, but according to these reports, Biden is going to come out and say he's going to try and block this.
Yeah, we had Al Root from Barron's on the show, who's been all over this story, and I thought Al's take was interesting. I mean, politically, he said, Biden, Harris, Trump all oppose this deal for the very good reason that United Steelworkers oppose the deal, and they would all very much like to carry the swing state of Pennsylvania. In Al's opinion, though, you can make the case it's good politics. He came on the show and said bad business. He crunched the numbers and said, listen, at the end of the day, U.S. Steel needs the money Nippon would offer. So it'll be interesting how this shakes out. Look at that reaction in the stock.
And in fact, the CEO of U.S. Steel telling the Wall Street Journal in an interview that the company is going to have to close plants if the deal doesn't happen. So will there be, it's hard to say, will there be a greater decrease in workers if the deal happened or if the deal doesn't happen?
Right.
I guess there's no way of knowing the counterfactual, but all of this at play as we talk about this deal.
One to watch.
Yeah.
Stocks moving on lower today following that JOLTS data as investors ramp up rate cut bets. For more on the latest market moves, let's welcome in David Sekera, Morningstar Chief U.S. Market Strategist. David, it is good to see you. I want to start on a theme I was just talking about with Julie there, and about the economic data we're getting, David, this week. So manufacturing and JOLTS, just got the Fed's beige book, David. It showed the number of districts reporting flat or declining activity actually jumped from 5 to 9. It does feel, David, like growth concerns starting to bubble up again. I wonder if you share those concerns.
Exactly. It does feel a lot like the beginning of August, at this point in time. Now, overall, we do think the stock market here is pretty fully valued. In fact, it's actually a couple % above a composite of our fair values. So not necessarily surprised to see a little bit of choppiness, a little bit of a pullback here, in the short term. And as you mentioned, I think the market right now is just trying to digest a slowing rate of economic growth. Now, in our view, it's not necessarily surprising. We've been in the soft landing camp for quite a while. We're actually looking for GDP in the first quarter, in this current quarter here, to slow down to 1.7%. We expect it to slow sequentially through the end of the year, getting all the way down to 1.2% in the fourth quarter, going to 1.1% in the first quarter, and then just slowly starting to reaccelerate thereafter. So from our point of view, when I look at the macroeconomics out there, I think the tailwinds right now are pretty much offsetting the headwinds. So that's why I would still consider, from a market point of view, to stay at a market weight, depending on your portfolio allocations. From the tailwind point of view, we expect inflation to continue to keep moderating from here. We're looking for long-term interest rates to be really on a multi-year decline, and then, of course, for the Fed to start easing monetary policy. So really, the only headwind is that slowing rate of economic growth.
Could be a big headwind, though, David, I guess, depending on how much it's slowing, right? So I did see some commentary today that the Fed, even before Friday's jobs report, would have enough material, given some of the economic data we've already gotten, to cut rates by a 0.5 percentage point. If they do that, what do you see as the sort of equity market reaction?
I'd actually be very concerned if they cut by 50 basis points. If they cut by 50, I think that actually could send the wrong signal to the marketplace. Of course, the Fed has been just laser focused on inflation for, the past 2 years now. For them to come out with a 50 basis point cut is really going to tell the market that they're actually much more concerned about the potential for a recession in the near term than they are about inflation. In that case, I think instead of, the market actually viewing that positively, I think the market would look at that negatively, and we could actually see stocks sell off in that case.
And so, David, so you wouldn't be looking for a supersized 50. You'd be looking for more traditional 25. How do you think the market would respond to 25? And what's the pace of cuts you would expect after that?
I think at this point the market's fully baked in the 25 basis point cut, so I don't really think there's going to be a huge market reaction, to the Federal Reserve. We're looking at 25 basis point cuts, each of the meetings, thereafter. So we're looking at, by the end of next year, the Fed to get down to about 3 to 3.25% range by the end of 2025. And even just as importantly, we are looking for a multi-year period of long-term interest rates coming down. So for the 10-year, we're currently forecasting the 10-year to get to 3.5% by the end of this year, and then falling to 3% by the end of 2026. So I think that will help, propel the market, give the market, good tailwind, over the next, call it 15 months or so.
And David, to dig a little bit more into your strategy, which you alluded to earlier, there are two groups that you are underweight that I want to dig into. One is technology and the other is utilities. And I mention them both in the same breath because they've sort of gone hand in hand very unusually this year. But you think it's time to pull back on those two groups?
Exactly. So with technology, I just think that too many of these AI stocks ran, too far, too fast here in the short term. They've definitely gotten to be overextended and in many cases, overvalued in our mind. So in that sector, I'd look to take profits out of there. Look for some of the other names that have lagged behind. But the utility sector is actually, in my mind, even more interesting, from a negative point of view today. That sector, I mean, it was just crashing last fall when interest rates were going up. In fact, we noted that, the utility sector on a valuation basis was pretty much as undervalued according to our valuations as they had been, over the past decade. But that sector's up, about 22% year to date. Even more than that, off of those lows from last October. So at this point, I think it's time to move, to an underweight there. The big story this year has been that utilities really are kind of that, second derivative on AI. Of course, electricity demand will be increasing as more AI comes out there because AI takes, many times more, power to run than traditional computing. But I'm just thinking right now, if you're buying utilities based on that theme, we think you're, 10 months too late to the trade. So now's a good time to be making some swaps, getting out of those overvalued utilities like Southern Company and Dominion Energy, two stocks that we rate with 2 stars, and look for the more undervalued ones out there like Evergy. That's a 4-star rated stock, trades at an 8% discount, and NiSource would be another one that's a 4-star rated stock, trades at a 5% discount.
How about small caps, David? They look interesting to you here?
Mm-hmm. Exactly. Small caps, when we look at them relative to the overall market, are trading at what we think are some of the lowest valuations on a relative basis that we've seen over the past decade. In fact, right now, the small cap category is trading at about a 16% discount to a composite of our fair values. So I think there's a lot of opportunity in small caps. Plus, just even away from kind of that fundamental basis, small caps historically have traded very well in times when interest rates are declining and the Fed is easing. So I think we're going to have some good positive technicals there as well.
David, thanks so much. Good to see you.
All right. Well, thank you.
Thanks. The Philadelphia Fed starting its search to replace President Patrick Harker. Yahoo Finance's Jennifer Schonberger has the details for us. Hi, Jen.
Good afternoon, Julie. Great to see you. That's right. The Philadelphia Federal Reserve announcing today that it's launching a search for a new president as its current chief, Patrick Harker, is set to retire next summer. Harker, who's been at the helm of the Philly Fed since 2015, is slated to exit the regional Fed bank on June 30th, 2025. Central bank rules require that regional Fed presidents retire when they hit age 65. Now, Harker told me he expects the central bank to begin cutting rates by 25 basis points this month as the central bank begins to ease monetary policy, and that he would be open to a larger cut if the labor market deteriorates suddenly.
If we saw a substantial change in the labor market to the downside, then I would be open to a larger cut, but not right now.
Harker says the labor market has softened, but it's still strong. Atlanta Fed President Raphael Bostic shares that sentiment, saying earlier today he believes the Fed needs to start cutting rates before inflation hits 2%, lest it disrupt the job market. And speaking of the job market, the Fed's Beige Book released this afternoon a compilation of anecdotal evidence across the Federal Reserve's 12 bank districts found that during August, employment levels were steady overall, but that there were isolated reports that firms filled only necessary positions, reduced hours and shifts, or lowered overall employment levels through reductions. Still, reports of layoffs remained rare. Now, guys, also of note, consumer spending fell in most districts during the month of August after holding steady in July, so perhaps adding to that narrative of a cooling economy. Back to you.
Thanks, Jennifer. Appreciate it. We're just getting started here on Market Domination. Coming up, shares of Dollar Tree sinking on the back of its latest earnings report. We'll check in on some of the stocks as well as that stock, as well as other trending tickers on the other side. Stay tuned. Much more Market Domination still to come. Time now for a look at some of the day's trending tickers. Verizon is where we begin, reportedly in advanced talks to acquire Frontier Communications. That's according to the Wall Street Journal. An announcement of a deal could potentially come this week. Frontier, worth over $7 billion in market cap, and even more after this gain that we're seeing today here. And Verizon basically would be looking to extend its broadband business, its broadband access here, because Frontier has about 3 million broadband customers.
Yeah, so Bloomberg reporting this is part of it, kind of that, to your point, Julie, kind of a broader trend in the space. Demand for data usage expected to grow, so telecom providers looking to kind of bulk up, strengthen their broadband offerings. Bloomberg also, which we broke the story, noting that Frontier has been facing pressure from activist investor JANA Partners to improve returns. So that's my mistake. The Journal had this story.
Bloomberg matched it. It ended up matching.
Had initiated an internal review of its business earlier this year. But you can see that's jumping Verizon under a bit of pressure.
Yeah, Frontier, by the way, exited bankruptcy a couple of years ago. It filed for bankruptcy in 2020. It came out of bankruptcy in 2021. And now this latest move here. It's been one of the smaller kind of telecom companies. Let's talk about Dollar Tree as well. Those shares are sinking sharply. It lowered its full year guidance. The discount retailer noting macro pressures on the purchasing behavior of Dollar Tree's middle and higher income consumers. And that is what is new here, because the sort of weakness among lower income consumers has been well known. Dollar Tree now highlighting that it is seeing that weakness in the middle and upper income consumers.
Yeah.
That's different. That's one of the things behind the cut to the forecast here, and one of the reasons stock is down so much.
Yeah, when you talk about these names, I mean, they do cater to lower income folks, and we know they've been under pressure, inflation and rates. So there's the macro. There's also the competition. I mean, you could think of names like Walmart.
Yeah.
In terms of obviously, which seems to be firing on all cylinders. In terms of what is ahead, Dollar Tree is reviewing strategic options for Family Dollar, but it didn't sound like we had any updates on that process right now.
And just quickly here, analysts got kind of colorful on this one. Scott Ciccarelli over at Truist, for example, he says investors expected a mess, and that's what they got.
Yeah.
But at the same time, he thinks the bad news is largely priced in, and he's still a buy on that name.
Interesting. All right, moving on to another name here. Lyft is planning to further cut down on its workforce as part of its restructuring to cut costs. The ride-sharing company will also eliminate dockless bikes and scooters. So companies saying, Julie, this is an effort to align strategic priorities and to reduce operating costs. We recently spoke with Lyft CEO David Risher, sounded very optimistic, confident from a marketplace perspective. Remember, he told us to feel super, super strong, his words, but obviously challenges. The stock is down nearly 25% this year. Yeah,
so trying to get smaller here. The company apparently is still going to have e-bikes, but not those dockless bikes and scooters. So that's where it's sort of focusing on here. They had about 3,000 employees at the end of last year, so cutting a decent number, 1% of them here. With the small workforce, it seems bigger, I guess, by comparison.
Yeah, most on the street are on the sidelines, and you'll hear a lot of them say is, no surprise after a move like that. They think valuation is reasonable. But I think, they'll tell clients they still think that the kind of key for this company is, can they sustain top line growth, still ramp profitability at the same time, and they're waiting for more proof points.
Let's talk about Hormel. Also, shares there sliding after it trimmed its full-year sales outlook, and that missed analyst expectations here. Looking into the outlook here, the company says commodity market conditions are one of the reasons that they are cutting the forecast. Continued softness in their contract manufacturing business within retail segment. In other words, them making processed meat and other foods for other brands. And then also they've had some problems at one of their plants in Virginia that they now have resolved, but there are some disruptions related to that.
Also, per Dow Jones, the company, Julie, is dealing with lower prices for whole bird turkeys this year. I don't know if you realize that.
I did not, in fact, realize that.
Yes, among other issues. And the CEO saying the expectation is that pressure on whole bird prices continues to the end of the year. Stock in the red this year and over the last 12 months.
You a spam guy?
Not lately.
Don't they
no.
make Spam? Isn't that
they
what
do?
Hormel
That's
is
another brand,
quite
right? And
famous for?
Skippy, Planters, the whole thing.
Oh,
yeah.
right, Planters. That's the peanut plant in Virginia that is problematic. All right, let's talk about Nvidia as well. Nvidia is extending its losses after suffering the largest ever one-day market capitalization drop yesterday. Adding on to recent pressures, the U.S. Justice Department investigation into the chip giant, the DOJ reportedly sending subpoenas to Nvidia in the escalating antitrust probe. So is it time to change the investing mindset in tech and in chips specifically? Here to discuss, Matt Stuckey, Northwestern Mutual Wealth Management Chief Portfolio Manager. Matt, thanks for being here. How are you thinking about Nvidia and that tech trade right now?
Look, right now, I think we're in a period of market volatility. I think there's a lot of monetary cross currents going on, investors questioning the overall kind of health of the economy and kind of what growth risks are building right now. And let's face it, Nvidia is not a defensive stock. And so, all of those factors to me equate out to a picture of continued volatility around something like Nvidia, which has a beta of 1.7. And so those moves are outsized as it relates to the individual name here.
So are there ways to play the AI trade, Matt, that you like that are less volatile?
Unfortunately, I don't think that there are ways to play it to get the specific AI representation that NVIDIA represents here. NVIDIA dominates the infrastructure layer of AI today, and that's the action that's playing out in terms of investment so far. Eventually, that should transform into platformization, and eventually applications that continue to fuel the investment and ecosystem surrounding AI, but we're just not there yet. So if you want exposure to the best of the best as it relates to AI equities, NVIDIA continues to dominate that trade. Now, I think you have to have a risk appetite that equates to what the ride in NVIDIA is likely to be. Look, we've been investors in NVIDIA since Q1 of 2019. And the backs and force in the name are very similar to other semiconductor positions that we've held in our portfolio over that period of time. You have to have a risk appetite that matches the ongoing volatility of the stocks that you own, and NVIDIA is one of those that's a higher risk name.
Let's broaden it out to the rest of tech a little bit here. Are you also sort of looking, as you said, NVIDIA is the one that's sort of viewed as best in class in AI specifically right now, but are you also sticking with, for those with a high risk appetite, some of the other large cap techs as well?
I think collectively, if you look at some of the largest technology names that are out there, those have really been carrying the water so far this year in the S&P 500 from a fundamental perspective and from a return perspective. And so if you look at just what the market expects the S&P 500 to earn this year, it's roughly been about flat throughout the year, just in terms of what the earnings level should be. But if you take out the top 6 names of the S&P 500, that number would be about 8% lower. Another way to put it is if you only invested in the top 6 names, the earnings expectations where we sit today for the calendar year of 2024 are 30% higher. And so there's a good fundamental story there. The problem you run into is the ongoing kind of valuation concerns that are starting to bubble up. Are these names just simply getting too expensive relative to the rest of the market? And I think that's where we need to have some debate around whether or not the ongoing feasibility of the valuation support is going to continue to be there if the growth outlook were to roll over for the U.S. economy.
Matt, we've talked today a lot, including with another strategist, about whether growth concerns are bubbling up. Given what we see with manufacturing activity, jolts, just now with the Fed's beige book, interested to get your perspective on that.
With so much talk about what the labor market is doing, I think I would just remind your viewers that focusing on the labor market is a good thing to do that, but let's just not forget that that's a lagging indicator of the health of the economy. And so weaknesses that are bubbling up in the labor markets are probably telling us that the leading indicators of the economy are continuing to compress further down into contraction territory. And if you look at the Conference Board leading economic indicators as a reference point for that, we're in a drawdown territory that we've only been in 4 other times in U.S. economic history post World War II. So there are some areas that we would say let's be a little bit cautious here as it relates to the forward outlook on the macro, and the labor market is again a lagging indicator, and it's finally starting to slow down quite a bit. Matt, great to have you on the show today. Thanks for joining us. Coming up, according to the city, a new era of green energy is here. We're going to break it down with a strategist on the other side. Stick around, much more market domination still to come.
A new era of green energy is here, according to Citi. Investors may find attractive opportunities for the taking amid a, quote, focus on cash generation and visible profitability. Here to break down the green investing landscape, we've got Citi U.S. equity strategist Drew Pettit. Drew, it's good to see you as always. I guess my first question to you is why now, right? We have seen a pullback in a lot of these so-called green names over the past year or so. Do you think now is that why, I should say, you guys are coming in and sort of taking another look at this area?
So looking at stocks just being down is probably not a good reason to think about re-engaging them. So it's all about the catalyst. So how do we get performance to reverse? I think we're nearing an election. I think we're pricing out some tail risk fears there. And we're nearing a Fed pivot point. So lower rates should help kind of green and clean again. But then on top of that, so those are kind of two, let's call it short-term catalysts. But I do think longer term, we actually see a fundamental inflection in these stocks where growth should reaccelerate and growth should outpace that of the broader market. So short-term catalysts to get us back in, longer-term catalysts for some sustainability of performance of these names.
Drew, when you talk about green investing and green stocks, how do you define those terms, Drew? What are the variables?
So for us, it's not about being necessarily a disruptor or a pure play. I don't need to be, let's call it like a solar panel company. We are looking for companies across the value chain that help support, let's call it cleaner use of energy, better use of resources. So to us, we want a broader definition because we're not just going to go from where we are today to this ultimate change in the future without some type of transition phase in between. And I think that's where there's a lot of opportunity to invest right now. And I think that's what a lot of people miss when they think about green.
And so when you open that aperture, so to speak, what other types of criteria do you incorporate? What other types of industries perhaps do you incorporate?
So I actually think industrials play a huge part of the green transition. So when you think about all of the processes to make the things that we use every day, we need to change manufacturing processes. We need to make those processes better so we can use our resources effectively. So industrials are a massive part of the green revolution. It's not just tech. It's not just EVs. It's not just solar. There's nuclear. I would say there's energy efficiency. And even thinking about a resource like water, which I feel like we didn't talk a lot about in the past cycle.
Drew, you mentioned politics. I want to just dig into that a little bit more. How much does it matter who's in the White House?
Oh, next question. No, I'm teasing. Honestly, everyone thinks a Dem being in the White House is going to be really great for green. The problem is in that scenario to us, you probably don't have a Democratic sweep. And even if you do, I think deficit spending gets really difficult. So to us, yeah, green might like a little bit more blue in the White House or in politics. But honestly, on the red side of things, I think if you make deregulation pushes more aggressive, that actually does support some areas of green like nuclear. And if you look at the IRA, for example, that's benefiting a lot of red districts. So to us, I think some of the fears politically are overblown for green, but honestly, some of the tail risks are coming out. So again, I think supportive after we get kind of past that hurdle in November.
And Drew, just to be clear here, when you say, and this has been widely reported, that some of those aspects of the IRA have been beneficial to red states, does that mean you don't think that those parts of the IRA are likely to be rolled back under any kind of election scenario?
No, we don't think so. And it comes back to, at the end of the day, it's not just the end pure play clean energy companies that benefit from this. It's the industrial complex. So no, we don't think IRAs get rolled back. Maybe it gets de-emphasized in the media. Maybe they don't talk about it as much. But again, not in our base case. So I don't think things are going to be as bad as some people might think in that scenario.
Drew, always good to have you join us. Thanks so much.
Oh, thanks for having me.
All right, now let's get to some calls of the day. B of A Security is giving Nasdaq a double upgrade, Julie, from underperform to buy. The notes citing profit acceleration, value expansion, the much talked about, but very rare, not that rare, but kind of rare, double upgrade. The target is 90. Argument basically they're saying the stock's cheap with the solutions segment now compromising 78% of revenues and growing, they say. Some of the parts valuation case is increasingly compelling. Also, they like what they see in terms of the pipeline of IPOs.
Yeah, a different way to say this is it's still valued like an exchange, but it's mostly no longer an exchange, or at least it doesn't get most of its revenues from the exchange business. It says just 19% of this year's estimated revenue comes from trading, but it's valued like other types of exchanges. And to your point, it gets a lot of its revenue now from its solutions business. And in that case, there would be things like S&P Global or MSCI that are more comparable to a NASDAQ. Or if you look at its fintech segment, there's other stocks that are more comparable to what it is. So it's just sort of a different way of thinking about NASDAQ.
Analysts saying management has noted there is a long pipeline of pre-IPO companies that are awaiting better macro conditions. And once the election passes and market settles, we expect that backlog to clear.
We will see if that's the case. Secondly, let's look at Morgan Stanley upgrading Astera Labs from equal weight to overweight. That note highlighting the pullback in the stock, creating an entry point and potential 50% growth in 2025. Those shares are up 6% today. And basically, they say this is the highest growth company in our coverage. And by the way, Astera Labs, for those who are not familiar, creates sort of connectivity within data centers, kind of within the AI universe, if you will. And they say the growth trajectory is strong. I guess there have been some knock-on effects from concerns about delays to Nvidia's Blackwell chip because Astera is involved in the implementation and connectivity of that. But Morgan Stanley saying now that that's sort of priced in.
They say some risks to consider, they told their clients. Competition is one. They expect Broadcom and Marvell, among others, to introduce competing solutions. Sustainability of AI spend also needs to be considered, a big thing we've talked about. Bottom line, Morgan Stanley fans.
Yes.
All right. Goldman Sachs annual global retailing conference kicking off today, and Yahoo Finance senior reporter Brooke DePalma is there on the ground. Now over to you, Brooke.
Good afternoon, Josh. That's right. I'm sitting here with Goldman Sachs Vice President, also a Brooke Roach. Thanks so much for joining us, rather.
Thank you.
Of course. So I want to kick off with some news today. The Nordstrom family is looking to take the company private at $23 per share, or $3.8 billion in cash. Now, we've seen other retailers get offers like a Macy's to go private. Would love to understand, is this part of a broader deal environment that we're seeing? And why exactly are these discussions happening right now?
It's a really good question, Brooke. And one of the things that we've seen in retail the last couple of quarters is an acceleration of the bifurcating trends in retail between market share winners, such as off-price and other specific brands that have newness and innovation that are comping quite positively, and a tougher trend in department stores overall, where they've seen negative comp trends, they've seen a more cautious outlook on their consumer, and they've even had to trim their back half guidance for both comp and for comps and for their opportunities to grow. And I think that's some of the reason why we're seeing some of these trend changes today.
I do want to take a step back and think big picture. It's so hard to describe the consumer in a few words, but if you could, what is the state of the U.S. consumer right now?
It's a good question. I think what we see in the U.S. consumer is somewhat of a choiceful consumer. The consumer needs a reason to buy. They're looking for value, but they do have discretionary cash income growth, and they do have money to spend. It's just that retailers and brands need to give consumers a reason to open up their wallets today.
Yeah, speaking of, we spoke with Amer Sports, particularly their brand architects, as well as Shark Ninja. It seems like they're proving against that. They have this willingness to spend, not so much from Macy's. What are we seeing in the difference between the low-income consumer and the high-income consumer right now?
You know, what's interesting is our data within the Goldman Sachs consumer discretionary cash flow model would suggest that the high-income consumer and the low-income consumer are both seeing discretionary cash flow growth. It's the middle-income consumer that's seeing a little bit lower growth this year in 2024. As we move into 2025, we actually think that that could get a little bit better across the board. But I think there's a more interesting trend behind what we're seeing between some of these retailers. You mentioned Arc'teryx with Amer Sports. You mentioned what we're seeing with Shark Ninja. The companies that are performing the best right now, that are gaining market share, regardless of price point or value proposition, are doing it through innovation. They're providing consumers value, not necessarily by competing on the lowest possible price point, right? Shark Ninja doesn't compete in opening price points at all.
Yeah, $400 for a Shark Ninja Luxe Cafe espresso machine.
Exactly. And as we think about some of those new innovations that have come to market, Shark Ninja has seen very strong performance of these items despite the higher price points in a choppy consumer backdrop, because they're providing a new innovation that provides value to the consumer relative to the other opportunities that they could see in the marketplace.
You also covered TJ Maxx. Curious, why are off-price retailers doing well in this sort of environment?
One of the things that we think that the off-price retailers do a very good job at is providing branded goods at a sharp value. They have a treasure hunt offering where consumers can go into the stores and they can find the item in the category that they want because they still want to consume, but they know that they don't have to overpay. I think over the course of the last few years, we've seen off-pricers develop stronger relationships with vendor partners, and you've seen a higher propensity of better brands in those stores that are offered at great values, and the consumer is reacting with higher levels of traffic, driving higher levels of transactions and greater market share growth.
For years, we heard all about the Lululemon belt bag being such a big hit. And then we heard in their recent quarter, they missed on revenue. It was the first time in more than 2 years that had happened. Have we reached a peak in Lululemon? What do you expect moving forward for the company?
It's a really good question. We think that Lululemon is managing through some execution issues today. They still have a very strong brand. They have strong market share, but some of the innovations that they've offered to the consumer recently just haven't been quite as strong relative to the offers that they had previously, whether that was year to date with some color misses or not having your size in stock. Every time that the consumer comes to Lulu and they don't necessarily have that right color, size, and silhouette in style, in stock at that time, is an opportunity for a missed conversion or a missed transaction. And we do think that Lulu can sequentially improve their execution, but we're waiting for more signs to see how quickly that might happen before becoming more constructive on the stock.
How are you thinking about the holiday season? What sort of challenges are consumers up against, and do you expect more promotions?
Very good question. Inventories have been very well controlled in retail over the course of the last couple of quarters, and we didn't actually see that promotional of a holiday season relative to fears last year. As we go through the holiday season, traffic and driving that consumer value will be very important to see how much more promotional it will be. While we always expect a promotional season, I do think that it is very notable that there are fewer shopping days between Thanksgiving and Christmas this year. We do have some noise with an election that is top of mind among consumers. And so there will be some competition as retailers compete on price with opening price points, but also competition as we think about the value and innovation that some of these retailers will use to drive market share growth.
Value and innovation seem like a key strategy this holiday season. Brooke Roach, Goldman Sachs Vice President, thanks so much for joining us.
Thank you.
Stay tuned for much more on Yahoo Finance Live.
When the NFL first announced Amazon's Prime Video as the home of Thursday Night Football, it felt like a seismic shift for how fans watched games. 3 years later, there are still plenty of games available on broadcast television, but streaming does slowly keep taking bigger pieces of that pie. Joining us now, Yahoo Finance's Alexander Canal with a look at the landscape as we go into football season.
Right, and it was only 3 years ago that the NFL signed that new media rights deal, welcoming Amazon Prime in for Thursday Night Football. But at the same time, you have to remember that more than any other league, the NFL also loves television. And when they re-signed and signed on Amazon, they also upped their agreements with some of those other traditional broadcasters like CBS, Fox, NBC, ABC. So there's this idea for the NFL that they want to make sure that they are everywhere, anything, all at once. That really seems to be the driving force here. I did just get a chance to speak with Hans Schroeder. He's the executive VP and COO of NFL Media. And he told me that what we're seeing with the media rights landscape is more of an evolution rather than a revolutionary concept at this point in time. He said for the NFL, it starts with that broad reach of our games. That's why 85% of the games, they are available on free-to-air platforms, but they also are recognizing that people are on other forms of distribution. They're on other digital screens, and they need to be smart in the way that they approach those different platforms as well. And we've seen that there's been more of an embrace of one-off games as well. If you think about Netflix, they are going to be airing an exclusive Christmas Day game. Amazon Prime is a Black Friday game. This is something that the NFL can do to, one, increase the fees that they're receiving, but also, again, feed into that concept of wherever fans are. Now, I did ask about whether or not we'll see more one-off games. He said that's probably more of the exception rather than the rule. They want to be careful about what they're really experimenting with at this point, but it just feels like, especially after the Olympics and how that multi-platform strategy seemed to work so well there, that there's an opportunity for the NFL to really lean into that as well. The gamification of games, you know, we had the Toy Story game, Nickelodeon game, that seems to be a play to bring in younger consumers. So there's just a lot of experimentation going on, especially when we're in this moment of disruption within media at large. And that just means you're going to have to subscribe to quite a few platforms if you want to be able to watch every single game in its entirety this season.
All right. Thank you, Allie. Appreciate it.
Thanks.
Football's back and is expected to bring record-breaking betting with it. According to the American Gaming Association, American adults will wager a staggering $35 billion on the NFL this season. That's more than a 30% increase over 2023. And with just a few minutes until the closing bell on Wall Street, we're now looking at how to navigate sports betting stocks with the Yahoo Finance Playbook. Joining us now is Jordan Bender, Citizens JMP Senior Equity Research Analyst. Jordan, great to see you.
Good to see you as well.
All right, so NFL's back. Chiefs, Ravens tomorrow night. Maybe just set the stage with us to begin, Jordan. When you think about the NFL, this sport, this league, how important is it to the broader sports betting market?
Yeah, you know, to follow on the previous conversation of growing the game, you know, sports betting will be an integral part of actually growing the NFL itself, and the sports betting companies are a way to do that as well. You know, you throw up the AGA number there. We had a note out this morning saying $33 billion will be wagered this season on the NFL, and that's obviously a record over last year. You know, the industry is still pretty young. It's growing every single year, and really what we're seeing is the evolution of a lot of these sports betting companies innovating, coming up with new products to drive new users, new customer acquisition into the space. The more eyeballs on the game, the more betting that's going to happen along the way. And we think this upcoming season is going to be a record for everyone.
And yet we're not really seeing that payoff for the stocks, at least not universally. Why is that?
You know, there's a couple of factors going on out there. You know, there's a lot of regulation headwinds that are kind of bubbling up on the surface as well. But, you know, really what we did is we stepped back and we said, we have 60% of the United States population that will have access to sports betting this year. From 2018 to now, we got 60%, but that's now starting to slow down. So when we think about slowing legalization, regulation starting to pop up, these operators need to find other ways to say, this is how we're going to grow the business in 2025 and 2026.
Rather than just getting new bettors.
Right. I mean, we look at the statistics now, and they're very, very impressive as we sit here today. You know, as we talk about stocks and we look at kind of the landscape in out years, it's how do you continue to drive more revenue out of that existing player, out of new people? This will be the least amount of the population that will enter the NFL season in the history of sports betting. It's obviously not that old, but that's kind of in the back of investors' mind of, in future years, where are you finding this extra growth?
I'm interested, we talk about the NFL a lot for good reason, but the WNBA, any line of sight there in terms of, has there been a jump in attention, wagers?
What we've heard from the DraftKings and FanDuels of the world is when you have a singular event or a player like Caitlin Clark enter the mix, you get more eyes on the sport. The Olympics is the same way. Caitlin Clark and these one-off kind of events that might happen, and that will get more attention and get people betting. So, at the end of the day, the NFL, the NHL, the NBA, those are the major wagering events in sports for at least U.S. sports betting operators. WNBA and some of the smaller sports, they might get a small bump along the way. You might get some headlines, but the overall piece of the pie is pretty small still for it.
So then the question becomes the question that you asked: how do they expand their revenue, their profitability in the out years? If it's not going to be expanding, you only have Olympics every so often. So how do they do it? And are there some that are better poised to do it than others?
So two companies, DraftKings and FanDuel, make up about 80% of the sports betting revenue in this country. For them, they've had the time advantage. They have the data, the people, the knowledge on how to run this industry. And with that comes product evolution. I was seeing today, DraftKings has their offerings out for the game tomorrow saying who won't score a touchdown tomorrow. And that's something new that they can offer that some of these companies might not be able to. But as the industry moves along with DraftKings and FanDuel and offers these props and other ways to bet, it's going to get more people to invest and or play on these apps and generate more revenue, even with slowing legalization.
I know, Jordan, you like DraftKings and Flutter, but if you had to push you, if you had to choose one, is there one you'd prefer?
We like FanDuel. That's the #1 sports betting and iGaming player here in the U.S. They're tied to the largest online global gaming company in the world. Again, we like scale, we like diversification. When you have the people and the data and the knowledge to know what you're doing, you can do it best. And the U.S. is a high growth market. They're the #1 player here. We like FanDuel, so Flutter's parent company, over DraftKings here into the NFL season.
And what about all the other guys, the other 20% that you mentioned?
Yeah, every year we preview the space into the NFL season, and it's always what company is going to disrupt FanDuel and DraftKings. And normally it's the niche small operators that might be
Where's the answer? Nobody, really.
That might be offering differentiated products. This year we think it's going to come from more of the mid-end. ESPN Bet, that's a big topic of discussion in the industry. Caesars, BetMGM, a lot of these companies that have balance sheets, databases that are really going to make investment pushes into the next 6 months.
What about, Jordan, some other names that maybe a bit under the radar, at least for some folks? But you cover, I know, like Sport Radar, Genius Sports. Would those be buys in your opinion?
Yeah, we like the data providers. So we actually upgraded Sport Radar this morning to market outperform. That's not an NFL play. That's more of an NBA play here in the U.S. But we think the picks and shovels, the backbones of the industry, the companies that you need to operate in the sports betting industry, those are the attractive plays. Genius Sports has been one of our top picks for quite some time. We think if you want to price a bet, if you're DraftKings and you want to price bet, you need Genius Sports during the NFL season. That revenue isn't going away, and those are long-term growth stories within this industry.
Jordan, that was really fun. Thanks so much for joining us in those picks. Appreciate it. While we're wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
There's the closing bell on Wall Street. Now it's market domination overtime. So let's see where the major averages ended the session. Actually in the green in the case of the Dow, just going up into the green in the final few moments of the trading day, up by about 38 points. So really barely eking out a gain. Not the case for the other majors, however. We saw a decrease of almost 0.2% for the S&P 500 and about 1/3% for the Nasdaq. Now remember, this morning we got jobs numbers in terms of the JOLTS report, jobs openings here at the lowest since January of 2021. Then this afternoon at 2 p.m., we got the so-called Beige Book of Economic Activity from the Federal Reserve, its survey of businesses in its various districts. And we saw an increase in the number of regions that saw flat or declining activity. So all of that may be making investors a little bit uneasy here going into Friday's jobs report in particular. So all of this watching very, very closely. We've also been watching yields very closely. They continue to push lower as we now have an uptick in what's being priced into the Fed funds futures market of a 0.5 percentage point cut by the Fed coming up in a couple of weeks. One more thing I want to mention here today, that we've seen a lot of volatility in oil as of late. We saw it kind of attempt to make a recovery today. That did not succeed, finishing lower by about 2%. And if you look at the groups in the S&P 500, it reflects some of those dynamics I was just talking about. We got energy, that is the worst performing group today, down 1.4%. Falling along with those oil prices. On the plus side, you got utilities, because we tend to see them move inversely to rates here. So utilities up as we see rates coming down, although utilities have seen a little bit more rockiness as of late. And then finally, we got to take a look at large cap tech as well, because Nvidia continuing its declines today. It too made an attempt at a recovery kind of midday. That did not succeed, so down about 1.7% on the heels of the report about an antitrust investigation kind of ticking higher from the Department of Justice, and kind of mixed picture elsewhere within the Nasdaq 100, Josh.
All right, Julie, for more on markets, we're joined now by Keith Lerner, Truist Co-Chief Investment Officer, Chief Market Strategist. Keith, always good to see you. I just want to start, Keith, where Julie was just talking about, just some of the economic data we'll be getting, Keith, this week. Manufacturing, JOLTS, you saw the Fed's Beige Book there. I'm just curious, your views on the U.S. economy, Keith, where we are and where we're headed and how that's shaping your views of the markets.
Sure, and always great to be with you, Josh and Julie. I think collectively, the data certainly shows the economy is cooling. And, it's collective, like you said, the JOLTS number, which, Fed Powell watches very closely, I think is an important one ahead of the jobs number. And as Julie just mentioned, the Fed fund futures is now pricing in about a 45% chance of a 50 basis rate cut. And I still think it's a bit of a coin flip based on Friday's employment report, but I think they have full justification to do so. When you look at their own dot plot, the unemployment rate now, today, is above what they thought it was going to be at the end of next year. So in our view, they need to start moving, and they should be more aggressive.
Is the equity market going to welcome that aggressiveness, Keith?
It's an interesting question, because I think, one point of view is that if the Fed goes 50 basis points and as opposed to 25 basis points, that will acknowledge that maybe something worse, like the economy is in worse shape. But from my perspective, if you started from today with a blank sheet of paper and you said to the Fed, here's the factors as far as where the employment picture is, their own neutral rate is around 3%, and this is the trend of the data, and you had no legacy issues, I think you would go more aggressive. And from a market perspective, if you only go 25 basis points, it's incremental. They're well above neutral. I think it would be better for them to go, and maybe there'd be a knee-jerk reaction. But ultimately, I think it would be better for them to be a bit more aggressive here, because we are certainly seeing cooling across the board.
I'm interested, Keith, we talk about the Fed. It's September as well, obviously historically tough month to be long the market. As a strategist, Keith, how do you think about seasonality? How does that shape your views, at least in the near intermediate term here?
Yeah, well, I will use seasonality and a weight of the evidence process. It's one factor, and it's not the only factor, but a couple of things do line up. I think everyone knows that September is a weak period. Historically, you can see in the chart you're showing right now that is the weakest month of the year. And then the other thing, as you get into October in an election year, you tend to see a spike in volatility as anxiety builds up ahead of the results. And then after you get on the other side of the election, typically you have a relief rally and a sigh of relief. So I guess the way I would think about this is we still think the primary trend for the market is higher. At this point, we're sticking with that. We would look at pullbacks as an opportunity to add for that because we still think the probabilities still support a fourth quarter rally. If I could just kind of share maybe one more stat, we've been up 9 out of the last 10 months for the S&P 500. Historically, the next month after you've had that type of gains, you're only up about 33% of the time. But as you expand that time frame, the probability of success or moving higher increases. So that also kind of reinforces our main thesis, which is these choppy waters into the election and then a rally into year end.
And Keith, one of the other things that we've been talking a lot about, I know you took note of it in your latest note, is the increasing breadth in the market. For so long, we were talking about, stocks are being pulled higher by those 9 of 10 months by large cap tech. That's no longer really the case. And in fact, the S&P equal weight index, I believe, closed at a record yesterday. It's pulling back a little bit here today. What do you make of that increasing breadth and kind of what it tells us about the sustainability of the rally?
Yeah, it's a good point. I mean, because we have seen a bit more of a defensive tone in the market, but you're also at the same token, you see financials make all-time highs recently, industrials make all-time highs, and as you just mentioned, the equal weight index also making fresh highs. So after that correction in August, when you start to rebound, the one thing we look at from a technical view is participation, or what you just said, breadth. And the good news, on a 10-day basis off that low, we saw advances lead decliners by a margin of 2-1. Historically, that is statistically significant. And when you look at 6 to 12 months, the market has a high probability of being higher. Again, on a short-term period, sometimes you use a lot of energy and you have a lot of back and forth. But overall, that's a healthy picture. And it's good to see that there's more than one place for investors to allocate. And you're all actually seeing the percentage of stocks in the S&P that are outperforming over the last 3 months around 60%. That's a multi-year high. So I think that's good for stock picking again.
Keith, I want to switch gears a bit and talk about gold as well with you. It looks like it raced earlier losses after that JOLTS data. The trends look positive from here, Keith?
Yeah, from a portfolio diversification standpoint, we added earlier this year a modest position. And there's a couple of things. One is from a technical perspective, it just made an all-time high. The underlying technical trends are very positive. You have central bank buying around the globe, especially with China. You still have a decent amount of geopolitical uncertainty, and it's also a hedge against dollar weakness as well. So you put all those things together, along with the Fed reducing rates, we think there's a place in a portfolio for at least a modest position in gold, and we think there's still upside to go for the yellow metal.
Keith, is there anywhere else, whether it's in stocks or other assets right now, that you think is being overlooked that investors absolutely have to be looking at?
Oh, that's a tough question, Julie. We ultimately, our favorite asset is still stocks. We just think we have to kind of get through this kind of sloppier transition period. So I still think that's the spot. And it's kind of boring because we still think U.S. large caps, and eventually we think money will rotate into tech. We don't know that it's oversold enough here yet. But besides that, we do actually also, looking at bonds, kind of plain vanilla bonds, they're acting like bonds again, meaning when we had the correction in August, they were actually up the most that we've seen in any correction since the pandemic. So I think just, it sounds boring and simple, but just going back to basic diversification works and sticking with large caps and higher quality at this point of the cycle makes sense. And then, using some of these pullbacks that we think we'll have, especially as we have anxiety into the election, as actually opportunities to pick up things that are cheap or are on sale.
All right. Sometimes boring works, Keith. That's just how it is. Thanks a lot. Good to see you as always. Really appreciate it.
Yeah, great to see you guys.
Former 2024 presidential candidate Vivek Ramaswamy joins the show next to discuss his outlook on the economy and the election. Stay tuned. More Market Domination Overtime coming up. It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is Market Domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers.
and expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
Getting the latest earnings now from Hewlett Packard Enterprise being on the top and bottom lines. Let's get you those numbers. The adjusted EPS, Q3 adjusted EPS, 50 cents versus 47 cents. So that's a beat, Julie. Q3 net revenue, 7.71 billion versus expectations of 7.66 billion. So beats there on the bottom and the top. They do see adjusted EPS 192 to 197. They had seen 185 to 195, so a boost there. But looks like they still see revenue adjusted for currency 1% to 3%. I'm not sure if that explains at least the initial reaction here. We're down about 3% in the after hours.
Yeah, just getting the statement here coming through from the company. And Antonio Neri, who we're going to actually hear from later in the week, or Brian Sozzi is going to be speaking to him. He talked about impressive revenue growth, especially from our AI system conversion, he said, and we also improved profitability. He talks about momentum in delivering on edge to cloud strategy across networking, hybrid cloud, and AI. So, again, as you say, all of that sounding positive, even though we are seeing a negative reaction in the numbers here. So we'll keep digging into it, figure out exactly what's going on here. It looks like their server revenue slightly missed estimates here in the third quarter. as you say, maybe that's part of what's going on. I'm going to keep digging through here, seeing if.
Yeah, I look forward to Saj's interview because you always want to hear from HPE just about, listen, obviously broader trends about the macro, what exactly he's seeing with his customers, what are they how are they spending, what are they spending on?
Yeah, let's also talk about C3 AI, that company out with its fiscal first quarter numbers. The company reporting a more narrow loss than expected, revenue in line with estimates, but the company's subscription revenue, it looks like missing estimates here, and the company leaving its full year revenue forecast unchanged. Watching those shares as well. We are also, by the way, going to hear from Tom Siebel, who is head of C3 AI, later in the week as well. He talked about fifth consecutive quarter of accelerating revenue growth for the company, and that demand for enterprise AI is intensifying. Again, though, the stock under pressure after subscription revenue missed estimates. All right, let's switch gears and let's get to Brian Sozzi in the newsroom. He's got an interview focused on the intersection of politics, policy, and the economy. Saz?
Yeah, tough quarter for C3AI. Nonetheless, this is a market clearly fixated on what the Federal Reserve may do with interest rates in just a few short weeks. If the Fed cuts rates, it could confirm an economic slowdown. If it doesn't cut rates, it could really upset the bulls. This, of course, comes against the backdrop of the November presidential election between Vice President Kamala Harris and former President Donald J. Trump. Joining us for more now is entrepreneur, author, and former Republican presidential candidate Vivek Ramaswamy. Vivek, good to see you. Welcome to Yahoo Finance. I would love to start on your take on the Federal Reserve. I caught your latest post on X. I thought it was very provocative. You bring up, or you discussed, this notion that perhaps the next administration should restrict the Federal Reserve's mandate. Walk us through this, because as we know here at Yahoo Finance, this is a market very fixated on all things Fed and what it may do and what it may not do.
Yeah, look, I think the reason that many actors, market actors, and by the way, I came from the world of hedge funds as my first career out of college. I've been interfacing with capital markets for a long time. The reason that many actors in capital markets pay, understandably, attention to the Fed isn't because they have some sort of special knowledge that other investors don't have. They're looking to the Fed to bluntly see what the Fed screws up next. I say that only somewhat facetiously because if you look at the last 20, 25 years, what you've seen is an expansion, a scope creep in what the U.S. Fed was supposed to be doing in the first place. Even the idea of trying to hit inflation and unemployment, two different targets, is like hitting two different targets on a dartboard with one arrow. You can't do it, and you end up badly missing on both. One of the great mistakes that I think the Federal Reserve has made over the last 20, 25 years as well is they've taken, let's just say, certain leading indicators, right? Like take indicators like, for example, employment. Take indicators like the unemployment rate or the jobs that are really trailing indicators of the job side of the business cycle, but pretending like they're a leading indicator of inflation. So that what that ends up having them do is tighten monetary policy right into when we're heading into a downturn in the economic cycle, which gives us a lot of the boom-bust bailout cycles that certainly we saw on steroids in 2008, but has continued, I think, as a pattern over the last several decades. So I personally believe the right policy is dollar stability. Make that the sole focus of the Fed's mandate and focus. That allows us to have more efficient markets with stable, not only a stable dollar, but stable prices as a consequence, and really allow for policymakers outside of the Fed to do their jobs rather than to be having rescued by the Fed for excess government spending. So that's how I see it.
You're making a lot of good points here, Vivek, and you know, this really brings to light, I think, a conversation I had with Judy Shelton, really an author, former Federal Reserve nominee under former President Donald J. Trump. She makes the case that we should go back to the gold standard. Would you agree with her at all?
Look, I think that there's sound logic behind that. One of the things I favored as a presidential candidate was tethering the dollar to a basket of commodities. You could put gold, silver, nickel, agricultural, farm commodities in that. But either way, I do think that tying the hands of the government is actually a good thing. Note that that's usually the counter argument against this, whether you want a gold standard or at least a normalized commodity tethered to standard. The best argument against that is that it doesn't give the government flexibility. The proponents of it agree with that, just view that as a virtue rather than as a vice. And the reality is if the government's hands are tied, that then reins in excess government spending that can't just be financed by printing money at the Federal Reserve's printing machine, which has been on hyperdrive for the better part of the last 2 decades.
Should crypto be part of that basket?
I think it can be in the long run. I don't think that it has, in many cases, aged enough to be on what I would say that day one basket. And not all crypto is the same as well. You could look at certain types of cryptocurrency, Bitcoin, for example, for which there's a fixed supply and no individual issuer. I do think that's a little bit different than something that has unlimited supply and clearly identified issuers. I personally believe that what we need in the next step of our evolution in the crypto landscape is clarity. Right now, what you're seeing from government agencies is a practice known as regulation by enforcement, which I think is anti-American at its core. It's where nobody knows exactly what the rules are, but you find out what the rules are based on how a government agency, be it in this case the SEC or others, may come down on individual firms, after the fact what the rules were based on the way they actually enforce them. That's not how this country is supposed to work. And so whether it's crypto or I would just say financial services more broadly, we deserve greater clarity rather than ambiguity. Ambiguity is the friend of the tyrant. And I think the American way is to say that we're a nation founded on the rule of law, where the same laws and the same rules apply to everyone, regardless of their political persuasion. That's the America I know and love, that probably most of us know and love, that we grew up in. I think the sad truth is that's not where we are today. That's the sad reality of where we are as a country, but I don't think we have to stay there. I think part of the problem in America today is, ironically, the people we elect to run the government, they're not even the ones who are actually anymore running the government, be it the congressmen, the senators, or even the US president. They're unelected bureaucrats in three-letter agencies. Some of those same agencies, the ones that write the rules, that then go on to enforce the rules, that at least until recently the Supreme Court cracked down on it, even had administrative law judges within their own agencies that were interpreting the rules. That's a violation of the separation of powers in the Constitution. And so do I think a lot of entrepreneurs and other actors in the crypto sector have suffered as a consequence of that? I do. But I don't think they're alone. I think that it's a far more pervasive problem. And the next step of evolution in crypto, we could talk about inclusion in commodity baskets, that's down the line. But the next step that I think that segment of the market needs and deserves is some element of regulatory and legal clarity that they don't have today.
How open or how much of a friend do you think the former president would be if he wins 4 more years? How much of a friend do you think he would be to the crypto community?
Well, I know that he would be a friend, and I know that I've had many conversations with him, that he's been very public about this, even in his recent speech at, say, the Bitcoin conference, where he's actually been thoughtful. He's also somebody who has, in many ways, seen firsthand, both as a U.S. president and in many ways as a victim of that administrative apparatus, what the dangers of an overreaching regulatory and bureaucratic state really are. And so Donald Trump is somebody who favors financial freedom. I know that's important to him, as it's important to me. One of the things I've respected about him is he's not one of these politicians who will try to pretend like he knows something when he doesn't know something about that issue. He's actually curious. And so in many of my conversations with him, and I'm sure between him and other industry leaders as well, he's developed his views on financial freedom, on the ability to self-custody your own assets, on what some leadership changes look like in the regulatory state and the thinning down of that regulatory state, the importance of regulatory clarity, something that many industries in the financial services sector, including and especially in the crypto sector, lack today. His speech at the Bitcoin conference was probably the best statement for where he stands. And as he alluded to in that speech, he and I have had some good conversations about what that future could look like.
As part of any, overhaul of the Federal Reserve, should the president have some form of say in what happens with interest rates?
So the reality is, here's the dirty little secret. The president has always had a say. It's just been via the bully pulpit, right? So do we want a system in which the president is communicating via bully pulpit with the U.S. Federal Reserve and its chairman? Or do we want at least one executive branch that at least is democratically accountable, where, yes, do you have certain people who are empowered to make decisions independently? Sure, but who are they accountable to ultimately? And I'm one of the people who believes that the people we elect to run the government should be the ones who actually run the government, which means we don't have 2 executive branches or 1,000 different executive branches. Read the Constitution. We have 1 executive branch. And so I think that just being honest with the fact that whether or not you pretend like there's some independence when in fact it's a backdoor dependency, let's just be honest about that through the front door. And I don't think that's such a bad thing.
We're coming up really in a few weeks. We might get that first Fed rate cut after a long period of these elevated interest rates. Do you think the Fed would be sowing the seeds of another boom and potential bust like you're suggesting?
Well, I can be a little bit cynical at times, but I have, let's just say, over a year ago, predicted that in the run-up to the presidential election, no matter what the conditions were, that we were going to see a rate cut anyway. And that goes to your last question, too, the idea of Fed independence. I think is itself a little bit of a myth, even in the current status quo. It looks like it's independent, but just because it has the appearance of independence doesn't mean that that's actually how it's behaving. It's always been affected by politics. The only question is how transparent that really is. And so I'm not saying that now. I've been predicting this for a long time. Lo and behold, what do we get? The 2 months leading up to an election looks like we're going to get a rate cut. And I think that that's no surprise. Now, what's going to be the consequence of that? Look, I think the Fed was too slow to raise rates. I think they've been too slow to cut rates now, so you could make economic arguments to support it. But I do think that if people pretend like politics and the upcoming election isn't playing some role in that calculus, I do think that that is a bit naive when we look at the realistic way in which a lot of these agencies, including the U.S. Fed, have been run for as long as they've existed.
Vivek, you're out there touring the country a lot, talking to business leaders and average people on the streets just trying to make it from paycheck to paycheck. What are some of their biggest concerns as it pertains to the economy? What would they like to see changed?
So look, I'm going to boil it down to the most important fact. Prices have gone up at a much faster rate and at a much greater magnitude than wages have gone up. It's that simple. So you could say inflation, you could use a lot of other fancy verbiage to describe this, but for the average ordinary American family, how much they pay for food, for electricity, for their activities of daily living, that is higher today than their wages have actually increased. I think the Federal Reserve is in part responsible for this. I think the regulatory state is in part responsible for this. I think bad policies over the last several years are undoubtedly responsible for it. One of the things I worry about now is in the name of addressing that problem, we're going to get even worse solutions that actually leave those everyday Americans worse off. One of them that concerns me the most, and to your audience, I expect this may be of interest, is Kamala Harris's proposal to levy a tax on unrealized capital gains. So for what people at home are wondering what that means if you own an asset and the government says it's worth a certain amount, be it a piece of land, be it a small business, be it another property that you own, even if you don't sell it, that is to say, even if you don't have the cash to pay your taxes from it, the government will still charge you that tax on an annual basis anyway. I think this is a formula for a second Great Depression. You've got people sitting on large, long-term capital gains of stocks they don't want to sell or portfolios they don't want to liquidate, who will nonetheless have to sell in order to pay taxes on unrealized gains. But it's not just one individual who has to do it. It's that the rest of the market has to do it at the exact same time, which creates a cycle of forced selling of a kind that we last saw in the 2008 financial crisis. So I personally believe this is one of the most boneheaded economic policies, if I can maybe direct about that we've heard in a long time. And yet it does appear to be one of the more serious policy proposals for the Democratic nominee for U.S. president. And that's the kind of debate that I think we need to be having on the policy merits that unfortunately, at least so far in the recent period that Kamala Harris has become the nominee, we have not yet had. And so I'm hopeful the presidential debate coming up first on September 10th, and we'll see if there's another one after that, as well as I hope greater media scrutiny of both candidates, frankly. Give Donald Trump credit because he's sat for tough interviews. It'd be great for the country if Kamala Harris did the same thing. But that's what I think voters are going to need, and certainly voters deserve before they're asked to make an incredibly important choice on November 5th.
A lot of good points in there. Vivek, really good to welcome you to Yahoo Finance. Look forward to staying in touch. Stay busy out there. We'll talk to you soon.
Take care, man. Thank you.
All right, stay tuned. Asking for a trend coming up on the other side of the break.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
Hello and welcome to Ask Me for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. The market in wait-and-see mode. Investors are on edge with each drip of economic data leading up to the Federal Reserve's September meeting, and it's almost a 50-50 split now as to whether the first rate cut this month is going to be 25 basis points or 50. And digging deeper into the state of the consumer, the co-CEOs of On weigh in on the sneaker market and how people are spending their money both in the U.S. and abroad. Plus, the box office bouncing back this summer thanks to some big hits. We're taking a look at the trends ahead and whether we could see people heading back to the theaters the way they used to pre-COVID. The Goldman Sachs Annual Global Retailing Conference kicking off today, and Yahoo Finance senior reporter Brooke DePalma is there on the ground now with a look into the sporting apparel scene. Brooke.
Hey, Josh, that's right. I'm sitting here with On Running co-CEOs Martin Hoffman and Mark Maurer. Great to have you both on. Thank you so much.
Thank you for having us.
You guys have such a great global perspective on the consumer right now. Martin, I'd love to start with you. How would you describe where the consumer is at right now in terms of their spending power?
So our consumer is in a very good position. So we see very strong demand all around the globe. We had an amazing first half of the year with 30% growth, 1 billion in sales, over 1 billion in sales, very strong gross profit margin, increased EBITDA margin. And over the summer, we have done so many exciting things that make it actually quite easy for us to be here at the conference today and to talk about this, to talk about light spray, Zendaya, the Olympics, and just the demand that we are seeing. And so we continue to win market share.
I do want to understand, Mark, you guys did launch in 2022 a pre-owned, a pre-sale option on your website. How is that performing? And do you think that consumers are really looking for that option right now?
Yeah, I think we're very happy with Onward, the program that we launched, especially in the US, and it allows you as a consumer to return your product back to On and basically resell it. It also allows us to have some product that is not in perfect condition and sell it. And it's not only way more sustainable, it also allows a new consumer to tap into On. And so it works very well. I think Martin had an example. It's the how much largest country by?
Well, we sell more in that Onwards program than we do in Italy, for example.
So you see it's actually working well, and it's really being adopted by the American consumer. And so we're looking forward to roll it out also in Europe and other countries.
I would love to hit on your stake in China. You do have, I believe, 25 stores there. It seems like On Running is immune to the slowdown that we're seeing there. Would you think that's the case, Martin?
We are still at the very beginning of our journey in China, and the consumers love us. But as you said, we have 25 stores. Most of our stores are too small, so we're actually looking for bigger spaces. But so we are growing from such a small base that the overall consumer landscape is less relevant. China, really, it's an execution game for us. So product market fit is there. We have a great team, predominantly Chinese people. And so it's all about executing, finding the right stores. We will be opening probably around 10, 12 stores a year. And then also online with Tmall. Live shopping is a very interesting shopping channel in China, and we invest in that, and it's a major part of our business. So very positive to bring China to 10% of our business very close.
Wow. Any year projection on when that might be the case, 10% of your business?
Well, it's part of the plan that we laid out for our 26 growth aspiration, 10% China, 10% apparel, and 10% own retail, and so that's all connected.
How are you thinking about potential tariffs ahead of the U.S. election? Martin, perhaps, or Mark?
Yeah, I think we are, in the end, we're still a relatively small player. I think we are trying to bring the right product to the right consumer, and we're observing closely what's happening on a global and political scale. We're working together with other brands, and what's important for us is that the US consumer can experience our technology in an affordable way, and I hope we can continue and the industry can continue to deliver that to the consumer.
I do want to hit on one of the latest technologies you have, light spray. It uses a robotic arm to spray a shoe in 3 minutes. How does this alleviate labor and also bring manufacturing closer to the consumer?
So there's 3 great things about light spray. It's a unique design, it's highly performing, and it allows us to manufacture it in a very automated way. So something that our industry has failed basically to do for a long time. And even more important, it's super sustainable. The CO2 footprint is already much lower than of a traditional product. So the upper has a CO2 footprint of 70% less, and it brings us closer to circularity. But it's really a unique design, and it differentiates us. And we think it can revolutionize the running industry and the footwear industry. But we are at the very beginning. So we had 1 robot in Paris. We were able to spray shoes. We will bring it to more places. But we really want to make this scale and bring it to the mass market.
When Yahoo Finance first started talking to you both about 4 to 5 years ago, you just had Roger Federer come onto the team. Now you have 3 players in the U.S. Open. You have more than 60 playing in the Paris Olympics. What sort of return do you see from these big names being part of the on-running team? And in addition to that, how do you possibly choose who to bring on?
Yeah, I think that's a very privileged position that we're in, that we get actually to choose. And what's very nice to see, I think that many of the athletes appreciate having more brands that they can select from. So I think a few years back you basically had 2 brands. So we see a lot of inbound interest from athletes, and then it comes down to who are authentic individuals that we want to partner with, and how do these individuals really verify the product and bring the product to their community. And this is, if we're looking into tennis, we're trying to create amazing product. We're having a player like Ben Shelton, and then we're tapping into the tennis community. And the same we're doing with, for example, Zendaya. She's helping us to really enter her community. We're doing a big focus in training, bringing apparel to a younger consumer. And the most beautiful thing is when we can bring Zendaya and Roger together and tap into both communities and play air tennis at the same time.
Them playing air tennis was something like I've never seen before. It was great, great ad as well, great partnership as well. Martin Hoffman and Mark Maurer, On Running co-CEOs, thank you so much for joining us.
Thank you for having us.
Josh, back to you in the studio.
Brooke DePalma, thank you. The S&P 500 and the Nasdaq slipping as the sluggish start to September continues. Yahoo Finance's Josh Schaefer joins us now with the trading day takeaways. Joshua.
All right, Josh, we got to start with that JOLTS data. That's job openings and the labor turnover survey, and it came in weaker than expected, coming in at about 7.6 million job openings in July, weakest number we've seen since January of 2021. And this is one of the charts we often create out of that JOLTS report. So this is the ratio of job openings per unemployed worker. How many jobs are out there for someone that's looking for a job? That ratio has fallen to about 1 to 1, you can see here. And what's interesting with this is you're now below what the 2019 average is. So not only is this perhaps a sign of labor market cooling, it's actually starting to fall below where we were before and trending downward. So we're actually cooling a little bit more than where we were in 2019. Economists taking that to reason essentially this is one of the drops in the bucket for maybe why the Fed should be cutting 50 basis points in September versus 25, because you're starting to see that labor market cool a little bit more than maybe the Fed wanted. And trends like this, as you can see, as it comes down, it normally kind of falls in a little bit of a straight line, which could be concerning. And
you're speaking to this broader theme we were talking about on the show today, which is how growth concerns may be bubbling up back in the bloodstream, because you had manufacturing and JOLTS, and then you had Fed's beige book that hit, districts reporting flat. or declining activity jumped from 5 to 9. Just seems like it's bubbling back up here.
And you heard from some of the districts within that Fed Beige Book too, highlighting that people are finding jobs harder to find, right? I think that's where we're at right now in this labor market story, at least from the data that we've had thus far this week, is it's not necessarily that the jobs aren't out there. I mean, look at the chart we're looking at here. Job openings to unemployed worker. We're at 2019. We're basically higher than we've been for the last 20 years, right? But it's harder than it was a year ago. It's harder than it was 2 years ago. And that's kind of where the story lies right now. And really the concern is just if it gets worse. But it seems like we're at sort of this perfect, it feels like we're at that soft landing phase, right? And the question is, does it get worse? And that's why some people are arguing for 50, which I will say, Josh, I'll tee myself up. That's our second takeaway, 50 basis points. And Neil Dutta highlighted an interesting thing looking at that first chart and then mentioning to remember the revisions that we've had, right? So when you take a look at the revisions, that big revision that we had, he said, well, maybe we shouldn't be focusing on non-farm payrolls on Friday because things like this happen. You get massive revisions. When you have massive revisions, maybe we should just be focusing on the other labor market data and the things you're referencing that we're just seeing overall weakness right now.
And it's interesting how the market would kind of react. We had a strategist on today who said, the traditional 25 is baked in. He was making the case. He thought if they did a supersized 50, it would be a negative, depending in terms of how the market might respond and react. But
yeah, it might shock investors
Yeah.
to some extent, I think, at that point. But one other thing we have been tracking here, I'm going to get over to point 3, a rotation out of tech. And I thought this was interesting from Kevin Gordon over at Schwab. Pretty simple thing to understand here. It's the percent of S&P 500 members that are outperforming the index, doing better than the S&P 500. Back when we were talking about this being a tech-led rally, no one's participating. June, right? This is the end of June. Only 17% of the index was doing better than the actual index. Right now, we are at 71, Josh. Going back to 1993, which was the furthest data that Schwab was looking at. This is the best outperformance we've seen from total S&P 500 companies in the last 30 years. So that's a pretty big eye-popping number, and it gives you a sense of, yes, we're talking about Nvidia down, big tech being weighed down, but the other stocks have been participating in this rally, and that's why we're still near record highs. Yes, we're talking about a little bit of a sell-off yesterday, a little bit of weight down today, but you're still pretty close to record highs with a lot of the market participating. Maybe there's reasons to be relatively happy about what's going on in the stock market.
Let's end on that high note. Note of optimism. Thank you, Joshua. Stick around. More Ask for Trend right on the other side. Summer box office numbers dropped double digits from last year, but a Labor Day surge for Deadpool and Wolverine has injected some life into the industry heading into the fall. For more on the state of the box office, we want to welcome in Gitesh Pandya, box office guru, founder, and editor. Gitesh, always good to see you.
Great to be here.
So let's start big picture. Summer box office, Gitesh. Crunch the numbers for us. How do we do versus last year?
Well, we're technically down from last year, which sounds bad, but however, May was the biggest reason for that. May was down versus last year because we didn't have the biggest movies. Because of the strikes last year that went almost to the end of last year, a lot of films were delayed. So this year, the first quarter, the spring, very, very bad. And that sort of held over into May. Didn't really jump back up the way the summer box office normally does because the content wasn't there. We didn't have the big
So it's not a pure
blockbusters.
apples to apples comparison.
It's not pure, but once we got the adrenaline going, that's the beginning of June. It's been gangbusters in June, July, and August. So we are up big right now during this current period with 2 movies breaking $600 million each. That never really happens.
Which are those 2?
Well, there's Inside Out 2.
Yeah.
This is from Disney and the Pixar.
Yeah.
Huge movie, just passed 650 million domestic. It's also over $1.6 billion worldwide. It is the #1 animated movie of all time.
Wow.
Nobody expected that to happen. It was expected to be big, but not this big. And then you have Deadpool and Wolverine. This is from the Fox part of the Disney library, getting into the MCU. Again, it's an R-rated film, the first time Marvel's doing this, at least under the Disney umbrella. Huge hit, over $1.26 billion worldwide so far. More of an American skew. It's more of a 48-52 skew versus international. Inside Out 2 did a much better proportionally internationally. But this is a big comeback for Marvel and for Pixar. These are 2 giant Disney silos that were underperforming for a couple of years. And now this year, both of them did overperformed. And now we're waiting on Disney proper to have a big hit, which will be later this year, Thanksgiving. They've got Moana 2. Should be a big hit, but we'll see on that. But Disney really leading the way this summer.
Let me ask you, when we talk about Deadpool and Wolverine being a real hit, how does that compare and contrast to, let's say, like a mega hit like Barbie last summer?
Well, it's funny you should mention that because they'll both end at the same level. You would never compare these 2 films, but both of them, I mean, that one did over 600 million last summer, and then this one already passed by 605 million for Deadpool and Wolverine. It's on its way to maybe 625, 630 million of a finish, pretty much same as Barbie. Overseas, maybe not as much, but still a huge, huge hit. It's an R-rated, ultra-violent movie, and it's a little bit of a shift for the MCU. So the big test was, will that audience come out? And it's bigger than the last Deadpool movie, so it's even bigger than what this franchise normally does.
All right, R-rated, ultra-violent, that's what's working in the theaters. Let me ask you this. We talked about what worked. What didn't? I mean, I don't want to use the word flop, but maybe what underwhelmed?
Right. Well, part of that was going back to, like I said, the month of May. Normally, that's the summer kickoff point. We had The Fall Guy, action comedy from Universal, kicking off the summer, the first weekend of May. Didn't really do big numbers, didn't even hit 100 million domestic. That's sort of standard for the American movie industry. And then Memorial Day weekend, huge time for giant tentpole, expensive movies to come out. Hollywood took a gamble on Furiosa, the Mad Max prequel movie. That one underperformed, a big budget flop for Warner Brothers. Just didn't really work in May. So those are 2 films that we expected more from, and they're action, and they've got either stars or a brand, so they should work on paper, but really disappointed.
I want to get you out here on this, Gitesh. When you think, bigger picture question, when you think about the box office industry, what does it actually look like going forward? Do you ever get back to what it was pre-COVID?
So we're not at the pre-pandemic level, but I think that what we've seen this summer is a good sign for the future. And it's all across different genres. So we were firing on all cylinders this summer. Animation was hot, superheroes, action, horror was doing well, even romance doing well, sci-fi. So all the different genres are working. People are going out to the movies to see theaters. It's not just one studio leading the way. It's not just one genre leading the way. Everything is sort of coming back in there. And it really comes down to the content. Content is king. Do the studios have good movies to come out with, and can they be marketed well? And one thing that we've seen as far as a trend goes, this continues over the last couple of years, the brands, the sequels, the prequels, those are the ones leading the way. People are looking at all the content, and some of the more original content, I'll wait and watch that at home. The big brands, the big sequels, the ones that take advantage of the big screen experience, let's go out and see it in theaters. Even though ticket prices are higher than ever, even though premium prices go up to almost $30 a ticket here in New York City for certain films on IMAX, people are paying it for the right big experience and brands.
All right, they're willing to pay up. Gitesh, always good to see you, my friend. Thank you.
Great to see you too, thanks.
Coming up, more Asking for a Trend right on the other side. Well, listen up, golf fans. This one's for you. Topgolf Callaway announcing it intends to split into two independent companies, and the stock soaring after hours. Callaway will operate as a golf equipment and active lifestyle company, and Topgolf, which will remain a venue-based golf entertainment business. The CEO of Topgolf Callaway adding in a statement, Topgolf has a different operating model, capital structure, and investment thesis than Callaway, making a separation of the best solution for both brands. While the company expects a spinoff of Topgolf into a standalone public company is the most likely path, the company will continue to evaluate other options to maximize shareholder value. Meanwhile, the labor market is rebalancing to a point where further softening in labor demand could hit jobs, not just openings. Yahoo Finance's Julie Hyman joins me now with a closer look. Julie.
Yeah, we keep talking about this change in the labor market and when we need to get more concerned. We got the JOLTS data this morning that we've been talking about, where we saw a drop to 6.67 million open jobs. That's still a lot of jobs, but it's still the lowest that we've seen since 2021. And in anticipation of this, a note out from Goldman Sachs' research team earlier in the week looked at some fundamentals within the labor market. And among them, they looked at the job openings numbers. This didn't include today's numbers, which probably would have gone somewhere right around here, but still shows a clearly slowing trend back towards historical norms, to be fair. And then the other thing that we're looking at here is the jobbed workers to the overall workforce gap. That is, they add up the number of people who have a job with the number of job openings, then they subtract the total labor force. In other words, this is a measure of tightness within the labor market on a percentage basis. And it's coming back down towards the zero level, meaning that the two things are more in balance, and this sort of going in line with what we're seeing in job openings. Again, one of the things I want you to take away from this chart, it is going back to a normalized level to where it was pre-pandemic. And indeed, in the same note, the chief U.S. economist at Goldman Sachs, David Merrill, said in an interview he doesn't think there is a meaningful labor market problem. He says if there is one, it is at most moderate. So he's not overly concerned about the labor market right now, but this is something to watch as it comes back into balance. Josh?
Thank you, Julie. Time now for what to watch Thursday, September 5th, starting off on jobs. The monthly ADP employment report for August is coming out in the morning. Economists forecast that number to increase to 145,000, giving us a clear picture of the labor market. And more on the jobs front, we're going to be getting weekly jobless claims numbers. That number expected to dip slightly to 230,000. Moving over to earnings, a new batch of earnings coming out tomorrow. Broadcom reporting third quarter earnings after the close. And finally, we'll get new weekly mortgage rate data from Freddie Mac. Rates have dropped the last 2 weeks. Good news for home buyers navigating what we know is a sluggish housing market. That's a wrap on today's Asking for a Trend. Have a great night.